of this so that you have that for your records as well. And we'll send that again in a separate email. So with that, we'll get started with introductions. My name is Matt Joyner. I am an AVP of Wealth Management for Fortis Capital Advisors. I head up our Pacific Northwest region, have been in the area for a number of years. And I also have Jackson Shaw with us, who's an estate planning and real estate attorney here with us in Portland as well. So Jackson, you're also with us.
I am. Hi there, I'm Jackson. I'm an attorney here based in Portland at Thede-Culpepper. My practice focuses largely on estate planning and administration, as well as advising charitable orgs. And I'm excited to speak a little bit with you, a little bit tonight about all we can share.
So before we jump into that, I want to thank everyone for coming as well, and just all of the great work that you do. I was on a call here earlier today, and someone was talking about getting a bread cat, and we were talking about their financial plan, and I said, well, you should really talk to a really great shelter or charity in the Philadelphia area. And so the conversation quickly changed to all the work that Meow Village does, and all the work that organizations like Meow Village do. And how important it is for the community and for animals and the care of animals. And so that was just kind of a funny thing I was thinking about today. Also, before we get started, I also want to talk about a little bit of important disclosure notices on here as well. Whenever you're making changes to your financial picture, or you're making changes to your investment portfolio, or doing something by way of tax or insurance, or even just adjusting your estate, it's always important to talk with a licensed professional to be able to do that. Jackson is a licensed estate planning attorney, I think both in Oregon and in Massachusetts, if I'm correct.
Oregon and Massachusetts, that's right, yep.
Yep. And I'm also here as a financial planner here in the Pacific Northwest. Of course, not limited to working with people just here in the Pacific Northwest, but again, important to think about there. All right, so charitable giving basics, I want to just jump right in. As far as giving contributions to an organization like Meow Village, contributions at a simple level are things like cash or money or investments or real property that's given to a charity. Deductions can be received by way of that, and we'll talk about the different ways that you can receive those deductions. And of course, they go to tax, exempt entities, which can include things like 501c3s, which Meow Village is one of them, nonprofit organizations, religious groups, or other community-based groups. There's a number of different vehicles that you can use, and they range in complexity. So you have on the far left side what would be your most simple charitable giving vehicles. These would be things like just donating cash, right, from your bank account, or writing a check to an organization. As we move further a bit along down the line, this would be things like donating appreciated stock or appreciated assets, setting up donor advised funds, an estate bequest, which Jackson will talk about, all the way up to even setting up a private foundation, and which actually falls towards more the most complex side of that. So we'll get into all these different vehicles today, but again, these are the range of ones that you typically find. And these also range from most common to least common as well. So just something to think about. So just jumping right in, donating cash and appreciated securities to public charities. That's the one most people are going to be the most common and familiar with. And because Meow Village is a public charity, anything that you give to Meow Village by way of cash is what's up to a 60% deduction against your adjustable gross income. So you have a lot of flexibility because Meow Village is a public charity compared to a private foundation, for example. Whereas if you give to a private foundation, you're only able to deduct up to 30% of your adjusted gross income. So that's nice as well. And if you get over that amount, so like let's say for example, you have an adjusted gross income of $100,000 and you donate $61,000 in that year, ultimately you can carry that extra $1,000 over to an additional 5 years. So there's a lot of flexibility that these types of giving can give you, but this tends to be the most common one you see. All right. The next one that we find to be common as well is what are called qualified charitable distributions. And qualified charitable distributions are where you get a deduction from contributing directly from your IRA or pre-tax monies. And these tend to be a little bit nicer because the deduction limit is much higher than 60% of adjusted gross income for most folks, right? So if you have an income of $100,000 a year, and you want to give 70,000 for whatever reason it might be, you can actually do that through a qualified charitable distribution and be able to take that as a deduction right away, as opposed to taking it from your other cash assets and donating them and then waiting until you get to 60% of adjusted gross income. These make the most sense when you have required minimum distribution. So folks may know when you turn 72, the government asks that you start distributing assets from your IRA. And so if you do a qualified charitable distribution, that's a deduction against that. It doesn't count as ordinary income to you, which is nice. So these make most sense, again, if you're over 70 and a half, where you don't necessarily need to take those required minimum distributions as income, and you'd face increased tax liability by taking that required minimum distribution as income. Okay, so that's qualified charitable distributions. The next one is tax efficiencies of leaving, retirement and brokerage accounts to charities. This is a question that we get a lot: is, what's the right assets to leave to a charity? Should I leave a brokerage account or a Roth IRA or a Roth 401k? What's the right structure to do that? And for the vast majority of people that I talk to, contributing a, pre-tax account, so that's typically going to be your IRA or 403b or 401k, that's going to make the most sense, because if you think about your heirs, your Roth IRA goes to them tax-free. And then in a brokerage account, your assets get stepped up in basis. So that kind of helps reduce the tax impact to your heirs because you get a step up in basis. Whereas the traditional IRA, rollover IRA, those distributions are taken out and they're taxed at ordinary income levels. So as a result, that's going to be a much higher tax burden. So if you're charitably inclined, that tends to be where most people will give from, is those IRAs, and tends to make a lot of sense. All right. Now, donor advised funds are becoming increasingly more popular, and I know this is an area of interest for the organization. Donor advised funds are, in a way, you can consider them a foundation light. Okay, and what that essentially means is that a donor advised fund is an entity that's set up, and they could be set up at any major brokerage. So they could be set up through Charles Schwab, Fidelity, E-Trade. You can set up a donor advised fund at any one of those major institutions. And a donor advised fund, essentially you put assets into the donor advised fund and you receive a deduction immediately, right away. But then you can decide, much like a private foundation would, of your ability to distribute assets. So you can decide, hey, you're going to give all of it in 1 year, or you can string it out over 5 years or 15 years or 20 years, whatever you want to do. It's a really nice way to be able to do that. So again, a lot of people will do this type of structure as opposed to a private foundation. And Jackson will talk a little bit about private foundations in a moment. Typically, where we see private foundations make a lot of sense is if there's going to be a bequest to an organization of about 10 million, that's usually where you're going to start to see a foundation be used. Anything below that, I would encourage someone to really consider a donor advised fund. There was an elderly lady who said, you know what, I've got 2 million I want to give, and I want to have my kids come together and have a foundation meeting every single year. And I think setting up a foundation would be great. There's a lot of regulatory and compliance items that are associated with setting up a private foundation. So typically that's not going to be the most efficient structure. A donor advised fund, you could still have the family meeting. You can still call it the Jones Family Foundation if you want to call it that, or the Smith Family Foundation, or whatever name foundation you want, and still have all of the flexibility that a foundation would give you. So these tend to be just a more efficient alternative to private foundations. All right. So this is what a donor advised fund looks like in practice. Essentially, the donor gives cash or other assets. The donor receives that tax deduction, and then you can distribute on how you want to distribute those funds. Of course, I have this nice graphic here that includes Meow Village as an organization that you could give to. All right. And with that, I'll have Jackson start to talk a little bit more about the estate bequest and some of the more legally technical questions. I think there's a question here. I guess, Jackson, do you want to stop and we could take a question before?
Sure, let's go for it.
One quick question before you get too far. With regard to donor advised funds, you had only one listed charity there on your little graphic. Is it limited to donating to one, or you can donate to multiple?
You can donate to multiple. I just included this little bracket right here, meaning that you can include multiple charities in a donor advised fund, of which Meow Village can, of course, be one of those.
We're a charity sandwich. I appreciate that. Thank you.
Yes.
All right. I'm going to pick it up with simple estate bequests. And here I'm talking about gifts that are coming through your will or revocable trust, and they should be thought of separately from gifts that may be through a beneficiary designation on your IRA or life insurance policy. Now, the first step, if you're thinking about making a bequest through your estate, particularly to a charity, would be to speak with an estate planning attorney to make sure it's done properly. There are really two buckets that you can think of for these bequests. One would be a specific bequest where you're setting out a particular amount of money or particular items, and those can range from small things, jewelry, paintings, up to your residence if you'd like. And then the other group would be residuary gifts. Typically, that's done by leaving a portion or the entire estate after taxes and expenses are paid, and you could leave that to a charity or charities if you're so inclined. One side note, there is an unlimited deduction for charitable bequests against your estate taxes, although I tend to advise people that that should not drive your charitable bequests at death. It's generally more favorable tax-wise to make them during life, and given the federal gift and estate tax exemption is historically high these days, and Oregon's estate tax begins at $1 million, really the tax savings is not what should be pushing for charitable exemption or charitable gifts in your will or revocable trust. Before we move on, a couple things to think about that you'll discuss with a lawyer if you're going to go ahead and make a bequest under your will or trust, and they'll help you pick out the right legal name for the charity. If it's a large gift, it's common to speak with the charity ahead of time. And if you are going to end up giving your entire estate or a large portion of your estate to one particular charity, it is not uncommon for them to be willing to serve as a personal representative of your estate or recommend someone that they like to work with. So moving away from simple bequests, I'm going to talk first about what are trusts that are called charitable remainder trusts. And now these are a type of split interest trust. There is a charitable portion and a non-charitable portion of these trusts. For a charitable remainder trust, as the name implies, the remainder portion is the charitable portion. What happens is a donor creates a trust, and during their life or a couple lifetimes, the donor, maybe a spouse, or a term of years not to exceed 20 years, the donor can receive income from the property that they've contributed to the trust. And at the end of the term of the trust, the property is distributed to charity. There are two main types that you'll hear about if you start to read or think about this type of gift planning. The first would be a charitable remainder annuity trust, and the second is a charitable remainder unitrust. Annuity and unitrust refer to the character of that income interest. With an annuity trust, the income amount is the same every year, so it mimics an annuity. Whereas with a unitrust, it is a specific percentage of the trust assets, but that's revalued every year. So depending on how the trust assets grow and change, that distribution amount as income to the donor or their specified beneficiaries may change. Now, these are particularly popular with folks who have a appreciated asset, a large appreciated asset. You can think of maybe a valuable piece of commercial real estate, something of that nature. And the reason for that is you can contribute it to a charitable remainder trust, receive an income tax deduction in the year of contribution, diversify that asset, so sell it and perhaps, buy a more diverse portfolio of securities, say. Have those securities grow over time, continue to receive income, and then carry out your charitable desire with the remainder gift. I think that covers it for CRTs. Now, if that wasn't clear, or it was about as clear as mud, there's a nice graphic here to help get your head wrapped around it. And you'll see the individual on the left, the donor, would contribute property to this trust and receive the immediate charitable deduction. During the term of the trust, there's an income stream that goes to beneficiaries, typically the donor or children or a spouse. And then at the end of the term of the trust, the remainder can go to charities, a charity or charities. You can name multiple. Here we've just picked Meow Village as an example. Moving up the line of complexity, we have charitable lead trusts. Now, these are almost the reverse of a charitable remainder trust, because here the income interest during the term of the trust goes to charity and the remainder goes to the non-charitable beneficiaries. Typically, we see this where folks are rather wealthy and they want to leave a large amount of wealth to a child or children, but also carry out a charitable gift in the interim. And the reason that it's used is a little bit beyond the scope of this talk, but you can leverage them in a fairly tax efficient manner to maximize the amount you can give within a gift tax exemption. Just like charitable remainder trusts, there are two main varieties, the charitable lead annuity trust and the charitable lead unitrust. Again, unitrust and annuity trust describes the character of the income interest. This time, that income would be going to the charitable beneficiary. To complicate matters further, there are yet subtypes of these trusts that speak to the income tax character of the trust, and they can be grantor or non-grantor, and that speaks to whether or not the donor is considered the owner for tax purposes of these lead trusts. And we have, again, a nice schematic here to help understand some of the mechanics. You'll see the donor contributes property, and during the term of the trust, income is passed out to charity or charities. And then when the term of the trust expires, the assets in some cases can go back to the donor, but more typically to other beneficiaries. Right. So here we're going to just talk about retained life estates as a means of charitable giving. And what this term is describing is a gift where a donor, typically their personal residence, but it could also be of their farm property, says that they will give that property to charity, usually at their passing. In the interim, they would continue to live at the property and treat the property as their own. This type of gift is appealing for folks. Usually we see it when folks don't have a whole lot of liquid cash assets that they are able to give to charity, but want to make a significant and generous gift to charity at their passing. And for most Americans, that would come, their wealth comes in the form of their home. And so it allows somebody to continue to live at their house during their lifetime and then pass on that property to a charity when they die. And there are, again, some tax benefits here. You can get an income tax deduction. Ultimately, estate taxes would be reduced, and as well as capital gains, of course, not selling the house on the open market. There are a number of things to consider if you're going to go ahead and create a retained life estate with the remainder to charity, and you'd want to speak with an attorney about them, but you'd work with the charity to discuss how utilities are paid, how capital improvements of the house are handled, and to map out, to plan, to make sure that you have the requisite assets to continue to live at your home, for example, if this was something that you wanted to do.
A couple other things on this as well. These tend to be very popular with universities. This is usually where we'll see this, where there's a lot of land around. Think Oregon State, where there's a lot of farmland around in the Corvallis area, where someone might bequest their farm or their homestead to the university, and it's a way for the university to grow its property that way. These are also popular with people who don't have necessarily heirs for themselves. They say, you know what, I don't have any nieces, nephews, children, grandchildren that I want to leave these assets to, and they decide they want to gift that way. So that's typically where we see this be a little bit more common. This tends to be one of the more or less common forms of estate gifting, but it is one we wanted to talk about because it is an important one. So just something to think about.
All right. So pooled income funds, another way to give to charity, but also receive some income from the assets that will ultimately go to charity. The structure is similar to a charitable remainder trust that I spoke about a little earlier on. You could think of these as a charitable remainder trust light. Money, assets are contributed to a group of assets, a fund, typically structured as a charitable trust. Those assets are managed and they generate income. And during a certain term, income is paid out to the donor. And then at the end of the term, the assets pass on to a designated charitable beneficiary. And usually you'd see these set up for a donor's lifetime. But the structure here allows for smaller gifts than would be efficient for creating a charitable remainder trust. And Matt alluded to it earlier. Last but not least, we have a private foundation. Now, typically, you see these where a wealthy family, individual, even corporation wants to create their own charitable entity. And this is not something to be taken lightly. As Matt said, usually folks tend to have at least $10 million that they are looking to contribute right away to get it up and running. Here you'd be creating an entirely new charitable entity. Typically, it's a nonprofit corporation. You'd file for tax exemption. And then there are a number of fairly onerous compliance requirements to keep in mind and monitor at all times. There's annual tax filings in the form of a Form 990-PF, but there's also significant requirements surrounding self-dealing, employing family members, distributions, allowable investments, things of that nature. And you'd be working closely with investment managers, accountants, and attorneys if this was something that was interesting to you and you had the means to undertake.
With that, we'll open it up to questions at this point. That concludes our prepared remarks on this, but would be happy to discuss any questions, anything that's top of mind. I know it sounded like there were some questions around donor advised funds from the organization, but would be happy to kind of discuss any of these in more detail.